Hello, St. John Baptist Church. Al McClaney here with a weekly stewardship video. As you can see on the screen, I have the scripture that we're going to be emphasizing this week, and that is Proverbs 21:5. Steady plotting brings prosperity. Hasty speculation brings poverty. And that's from the Living Bible. And as always, no advice should be seen as recommendation, as I'm not a licensed financial advisor, and it's for educational purposes only. So the steady plotting brings prosperity. I'm going to deal with in the first part with a video from Compass. And that's just emphasizing what we've been saying in the last couple of weeks. There is a time to be investing. And while the market is down, if you have not been participating, this may be a good time to invest in stocks that in the past have been out of our reach because of price. For instance, Disney, or for instance, Boeing. But again, do your own research, and the names I'm using are just as examples, and they are not seen as recommendations. So the first part will deal with the steady plotting. Then I'll talk about the hasty speculation brings poverty, because there is a time when if we use patience and wisdom to go in to this market.
What advice does the Bible have on investing?
Well, in Proverbs 21, verse 20, Solomon gives us a key investing principle that applies to us all. He said, steady plotting brings prosperity. This is the principle of compounding. And let me give you an example of the power of steady plotting. If you save and invest only $2.74 a day, that's $1,000 a year, and you do it for 40 years and earn 10%, you'll end up with more than $525,000. And get this, it'll be earning more than $4,000 a month. Steady plotting pays. You don't have to invest a lot, but you need to be consistent. And the sooner you start, the better.
And as we had said before, there is a time that there's great opportunity. We don't want to just sound doom and gloom, but there's a time for opportunity. But we want to be cautious. And you see this next slide, this represents the hasty speculation, or I want to emphasize being cautious. So I was on a trading webinar, and there was a poll that was taken. It was about 1,000 of us, and we responded to the question, once the stay-at-home orders are lifted, how long do you wait to go out to eat, to a movie, on a plane, etc.? And what I think this represents is when the economy starts to open up, which this week they're starting to loosen up and have businesses open, does that mean that the economy just come right back? Well, you could just look at this poll of us, 1,000 people that were on this conference. No. So if you look at 40% of the people said, I'll wait a few weeks. There were some 10% that said, hey, I'm enjoying this particular life. I'm enjoying being a hermit. 30% said, I'll wait a few months. And then 21%, which is a small number, said, I'll go immediately. So we can see and use this information as investors to look at the fact that even though they're opening up businesses, there's still going to be a cautious response to it, if you will, and a slow grind to the economy opening up. So how does that affect the current market? And we've been using this chart, the SPY, which is a exchange traded fund representing the 500 largest companies in the US. And just a quick review, this was the high for the year when we were just rocking and rolling in the market. And then when the coronavirus started to hit, you can see the decline that happened when we hit that low on March 23rd, and we started to recover. And we talked about these levels, and you can see how the market continues to respect these levels. This represents a 50% retracement from that high. And then this represents the 61.8%. And we've talked about the 61.8. If we crack through that, that could be good news. And if it's sustained, that could mean that we're on our way to a recovery. But notice how it's been respecting these levels. You see 50% we got through. We were getting the good news regarding possible drugs that could give some relief to the virus. You can also see where a stimulus package, we call it hopium, was happening. The second one occurred. Then the reality of earnings started to hit, and we started to also see that the unemployment numbers. So even though we knew they were going to be bad, it's the idea that once you finally hear and actually see the numbers, you can see the market started turning over. Again, the market doesn't know these numbers, but it's amazing how it respects these numbers. So it got above the 50%. So as I've been saying, will it continue to bounce through? We don't know. Will it have enough power to come back up and get through this? Or as most have said, or some believe, that it'll just bounce, and it could be months between these two levels. Or do we head down, go through that 50% and head down again? We don't know, but it's just amazing how those numbers and those levels continue to be respected. So let's look at QQQ, and that represents the exchange traded fund that is predominantly tech. And we've said that's been leading us out, and you notice it's been ahead of the S&P 500. We did get above the 61%. It hasn't been able to sustain it. Well, it has sustained it so far, but it looks like it may retest it. Will it go through the 61% and keep going and bounce again? Or will it bounce off of that? We don't know. So again, this week is going to be interesting on what occurs. So last week I talked about what might have flipped this over. We started getting reports from Amazon. While their earnings were good, the forward-looking earnings projected, they're saying we're going to have trouble. Apple reported, Microsoft reported. So we had the giants of tech that were reporting. Google, Facebook all reported. Again, they were cautious about forward looking. So this could have been one of the reasons why the market in the tech area started to turn down. So I talked about some of the bad news that started hitting. So we got our gross domestic product. You may hear them referred to as GDP. And what that is, just a simplistic definition, is that is like the sum total of all the products and services being produced, combining that with consumer spending, and we come up with a number. Well, of course, a positive number means that the economy is healthy. And you can see this looks back over the different quarters. You see in 2008, that's when we had the recession. So the textbook definition is negative growth for 2 straight quarters. And you can see we went into a recession. All recessions will have a bear market, meaning the market is down. But we've also seen where all bear markets, meaning, remember, bear fights with his paw down, bull fights with horns up. Bull is good, market going up. Paws down, meaning the market's going down. So every bear market does not necessarily mean we go into a recession, but every recession has resulted in a bear market. So the textbook definition is 2 straight quarters of negative growth. So if we got one in, it's most likely we'll have a second quarter of negative growth, and we'll be officially considered in a recession. But we know from the news, with the number of job losses out there and the number of businesses now reporting that they did not make their earnings, most likely, I mean, we're already in the recession. But as we said before, there are opportunities there. But I want to emphasize the caution. That's the portion of Proverbs 21:5 saying hasty speculation, because there are some who are jumping right back in and say, oh, it's over, let's go. I would love to say that'd be great if it does, but we want to be cautious and use the wisdom that God has given us. So I always like to leave you with a resource, and here's a resource on this website, TomTom, which is taking traffic data. And here's the website that you go out. This is free, and then this is a screenshot, so I'm not out live on this site. But if you type in your city, in this case, I used Dallas-Fort Worth area because this is where we are. And what this represents is this is the last 7 days of traffic. And this red line represents now. The dotted line, which it may be hard to see on the video, so ensure you go out to this website. This represents 2019 traffic. And how can you use this as a resource? Well, until we start getting back to the levels of last year, then you know the economy is not has recovered or is recovering at a certain pace, because traffic, it represents people going to work, trucks on the road, services, rental cars, all of that. It's in there, and you can see we still got a lot of room to go. So here's the peak times. You would think, 7 a.m. in the morning, people are going to work. You see that those were peaking. And here's 5 p.m. last year. So that was 7 a.m. rush hour last year. And here's 5 p.m. people going home. And then you compare it to where we are now, which is this red line, and you can see a lot of room for growth. We ticked up a little bit, uh, but it's still not compared to last year. So that's Dallas Fort Worth. So I also looked at Wuhan. And why Wuhan? Because Wuhan was the first outbreak. It was one of the worst. They shut down that province within China, and they've now been 30 to 45 days where they've reopened. And you can see while it's coming back, it still hadn't reached the levels of last year, but they're starting to return and getting closer to intersecting with that line. And it still may be, it's gotten this far because they've opened up, but if you've seen any video of the Wuhan area, they're still practicing a certain amount of social distancing. They're still wearing masks. So it still could be a while before they get back to those levels. So how do we use that? As I said again, use this as confirmation that the economy is coming back. And that's going to represent more spending, people on the road, returning back to a norm. As always, I like to remind about the disclaimer. No advice should be seen as a recommendation. I'm not a licensed financial advisor. This is for educational purposes only. And we will see you next week. And we'll have another video that I hope you find is relevant and valuable.